My name is Brett Heath. I am the CEO of Metalla Royalty. We are focused on gold, silver, and copper royalties. We've got 101 assets across the Americas and Australia. We also have a very significant growth profile, and most of our royalties are operated by some of the largest, most experienced operators in the business across most of the proven geological trends, and with a very exciting growth profile.
Brett, welcome to London. Glad to have you here. Saw you last in PDAC. Good show. How's this one working out for you over here?
It's working out great. We actually were not part of the conference this year.
Right.
We didn't sign up for the conference.
Saving your shareholders' money.
Exactly.
Well done.
But we are doing a little bit of marketing, a little bit of business development over here, and yeah, it's going really well.
Okay. People are like getting and understanding the business model. They understand what you set out to do.
They are, and it's starting to resonate. Unfortunately, this sector has been starved of long-term capital, and the capital that it has attracted, or you could say what is left within this sector, is very, very short-term oriented, which makes it a bit difficult to grow a business that's really a long-term focus. We took a very long-term approach when we started back in 2016.
Yeah.
And luckily we were able to find really great long-term supportive shareholders that kind of had that same view. And we've executed. We executed 32 transactions over those 8 years.
Yeah.
Most of that stuff was on development as part of the strategy. And now we're seeing kind of all of that at our doorstep, all of that start to come into production. Yeah. And so of years of really kind of reinvesting and growing in the business, where I think we're kind of getting into this harvest phase, which I think is going to be really exciting, and it's resonating with the institutions.
It's an interesting point you make about the type of money that's available out there. We've seen lots of M&A happening, mergers of equals, whatever, however you want to frame that thing. And people expect that money to come cascading down throughout all of the industry, through developers into exploration, maybe royalties as well. But they haven't had it easy. That money has been waiting a long time for those projects to, I guess, materialize in some way, shape, or form. Do you think any of that money is going to find it slightly easier coming into royalty profile, certainly one which is advancing into the kind of harvesting phase, as you call it?
Well, I think the capital has been really focused around the next quarter. And as a result of that, it's very, very focused on operational and cash flow and so forth. That's where we saw with our kind of portfolio and kind of the different valuations over the last 8 years, where we kind of quite wild swings. Along the same time, we're executing the exact same business and really kind of performing the exact same way. But it's interesting because we had to make that decision. When you're growing a business, like, the market's always going to be changing, and a lot of CEOs are faced with, do we change our business to whatever is the flavor of the month? And unfortunately, like, I think companies that end up doing that feel a little bit of a relief in the short term, but inevitably over the long term, they run into trouble, they get taken out, they put themselves in vulnerable positions. And what we found is, like, look, if especially in the royalty business, if you really focus on really the high quality assets, you have that long term time horizon, then the rest of it really kind of takes care of itself. And so
I guess what I'm trying to get at is my timing for entry. Like, when you started way back when, you appealed to a group of people who said, like, I like you, Brett, I like what you've done, and I like the model, but I know I'm going to be sitting around waiting for this thing to get to harvest phase, but I'm getting in cheap and I'm prepared to put my money in there. Today, you're not necessarily going to attract the same sort of profile of investor. You're going to be maybe able to say to people, look, we're in the harvesting phase, it's nearer to the revenue phase. That will give us some kind of a creative growth profile, however people like to rank that risk or that revenue. So is that a bigger pool of capital that you can appeal to now? It's a different profile investor?
Yeah, it is. And look, when you're growing a company from scratch like we did, I mean, we started with no cash, no assets. And you are not forced, but I mean, the support for your business at that stage is retail. That's what it is. I mean, institutions don't go that far down the food chain, if you will. And so, retail was, that was how we funded our transactions, and we, we're very strategic and successful at doing that kind of over the first 5 years, and we saw some great returns, and then the market kind of changed, and unfortunately, when the market changed, like that also kind of changed the behavior of the retail investor as well, because for so long, the world was forced to speculate to get any type of return on capital because interest rates were zero. But all of a sudden, people could have a savings account that was kicking off 4 or 5%, and the behavior changed. And so with that, retail kind of slowly exited the sector, particularly on any company within the mining equities. I'd say like sub-billion market cap really felt, which I think they continue to feel today. And on the other side of that, as you noted, as you get into a business that is generating cash flow and more significant cash flow growth, then the institutions really kind of pick it up from there.
Right.
And so that's the stage that we're at today.
But then you need to perform a few things yourself. You need to kind of get the share price at a certain level. You need the kind of liquidity there. You need to show either a path to share price gain or dividends, which, you're a dividend paying company because we're throwing out enough cash, or a plan which says, here's the growth plan, we're going to reinvest into similar profile business. And they are quite, some of the names that you've got are exceptional. Some of the biggest projects in the world. Longer gestation period, clearly, but when they go, and they go hard. That's the idea. So there's a few things that you still got to deliver on there for the institutional guys.
Yeah, and look, they're interested in seeing kind of year over year consecutive growth. Yeah. They're interested in seeing a company that's got, year over year EBITDA growth. Companies that are covering all their costs and have the ability to kick off a dividend or self-fund acquisitions. And I think that's the position we'll be in 2025. I think that's really kind of kicking off this quarter, Q4. I think it's going to start to kick off, and I think we should see, consecutive revenue increases and record revenue kind of year after year for the balance of this decade.
When did you put out guidance? Next February, so.
We'll put out guidance in March.
In March, okay. How does that happen? How do you work with the companies to work out what the schedule they're on? Do you get the same market information we do, or do they kind of let you?
Yeah, well, typically the majors and the mid-tiers will provide guidance when they report their annual financial statements, which is normally like in March. So we'll kind of see what they're all saying
thereafter,
and then we got to put it together to put ours out. I mean, we have a pretty good idea.
Okay.
We have a pretty good idea. I mean, I think we're kind of positioned for almost a double of what we'll probably get in 2024 and 2025. Okay. I think in 26 we'll see another significant increase. Same for 27. And this growth is now becoming much easier to wrap your head around it. These are like big, very, very significant projects. They're funded, and so as we kind of get into that, we've got this nice kind of CAGR between now and call it 2027. That I think. And this isn't formal guidance, but I think will, take us from kind of where we are today, upwards to probably kind of 8,000 to 10,000 gold equivalent ounces by 2027. Okay. And that really leads into some very, very significant growth that we're expecting kind of in those next 2 years. Yeah. Which could easily double or even more contribute to our gold equivalent production. And again, these are really high profile assets that are coming online with very significant runways.
Right. Because you need that kind of double-digit revenue number just to get noticed in this market. You're going to hit that real quick.
We're going to hit that. Yeah, we're going to hit that real quick. And I find that in this industry, the executives generally are, and I think this is a function of unfortunately the capital that's left, but it's very short-term oriented type of thinking. And when you're running a business in any sector, what?
Do you blame them? It's been like some blow-ups the last 18 months, right?
Yeah, I mean, look, in any sector, if the CEO and the board is not constantly thinking about what the world looks like in 2 or 3 years, then those companies get left behind. They get left behind. They get in trouble. And when I look back, kind of the actions, the deals that we were doing, 2-3 years ago, basically since we started.
Yeah.
And looking at kind of how are we going to position ourselves as we get into this next cycle.
Yeah.
And understanding look, we don't want to be going out and being forced to redeploy a bunch of cash in a bull market with prices that are when you need to be kind of a bit more cautious.
Yeah.
And when we look at it today, the royalty business is all about the cycles. I mean, when you look at the big royalty companies, most of their growth were in these little pockets, right? 12, 18 months. And how can you because for Metalla, we kind of think in these phases, right? And you've got this kind of junior phase, and then you've got this mid-tier phase, and this major phase, and getting to these different phases is extremely difficult.
Yeah.
Very, very few companies have been able to kind of make these leaps, but what is required for our business to compete at that next level?
Yeah.
And when you look at the profile of our cash flow, we feel that, not only does it have the longevity to play the cycles, absolutely key, but also our cost of capital should decrease over the next few years to become reasonably competitive.
Sure.
Within kind of that, call it mid-tier type of transaction size, and our access to capital should increase. And once we kind of can get to that level, then we can do what we've done and executed on so well over the last 8 years, which is we can find these deals. We can find these deals. We can get them done on our own outside competitive processes. Now, are we going to do 4 or 6 deals like we did a year?
Yeah.
Probably not. But can we do 1? Can we do 2? I think that it's probable.
It's kind of more important now because it's kind of, I asked you last time we met, I remember this, where I said, do you think you've grown up? Because you've had to in a way. There's a kind of naiveness and innocence and arrogance and expectation when you start off and think we know what we're doing, but let's do it. And that's fantastic. That's entrepreneurialism, 101. And then you kind of work out, well, actually, we got lucky. That was great. Yeah. Well, we were smart, whatever. But now you're entering the type of deal profile, which is, the big boy territory, right? So things are important. The cost of capital is clearly important, but it's competitive anyway, without the kind of cost of capital burden in there. Can you compete? Can you find the deals like you were once able to so easily? And are there good deals left out there that need your money at this moment in time? And, do you know what I mean? It's a tough, more, but it's also going to be harder.
Yeah, and look, I mean, the key again is having the ability to remain disciplined and patient, because that's also a very difficult thing in this business. Everyone's hanging on when's your next transaction? We're expecting, especially for so long doing so many different deals. And, with the growth profile that we have,
you bought yourself that time.
We bought ourselves an entire cycle. Yeah. I mean, we should see growth in our portfolio bought and paid for through the next decade. I mean, into the mid 2030s. And like I said, our reserve life of our top 10 assets is 20 years. It's the most out of all the mid-tiers and juniors. So, we have that ability to, I think, play those cycles. And I think as we kind of get a little bit further into the next few years, we're going to be competitive. We're going to have the access to the capital that we need to grow our business. And when we think about it from a mid-tier perspective, okay, well, what do we, how do we scale that business into being a leader? Well, you really only need to do 1 or 2 transactions a year is the truth. And you're doing ones that incrementally will add 3,000, 4,000, 5,000 gold equivalent ounces per transaction. They're big deals. But you need to make sure, specifically like what we've done since the very beginning is really understand the risk profile. So what we're not going to do is go out and write a big check to a single asset developer junior.
Yeah.
There's nothing like that in our portfolio basically today.
Yeah.
And so we're going to have to be creative. It's not going to be easy, but we've got the team. We've done it many times, and I think we've got the ability to have kind of an edge to allow us to grow. At the same time, this is the important part.
Okay.
Again, like this is thinking out kind of 2 or 3 years. We're in a consolidation phase right now. We went through this huge explosion when cost of capital became very inexpensive because there were very low barrier entries to create a royalty business. So there was royalty businesses popping up everywhere, as you recall. You're very kind of well immersed in all that. It's on the other side now. Now, cost of capital is very expensive. Very difficult for any junior royalty company to be able to acquire really good assets because good assets are still fairly competitive.
Yeah.
I mean, obviously, there's ones here and there that you can kind of find and get good deals on and so forth. But generally, if it's a higher profile asset, it's going to be it's going to be competitive and it's going to require. I mean, the junior level of cost of capital is much greater than kind of where these things are trading at. So, like I think I think a lot of the consolidation will be kind of necessity consolidation within the juniors. I think there's real potential that we see consolidation within the majors and the mid tiers. Not yet, but there will come a point in time where I believe that it'll start to be difficult for the majors to deploy capital into assets at NAV because of lack of opportunities. And I'm saying opportunities that are going to move the needle for them, like $500 million and up.
Yeah, by genius I mean sub-billion. Yeah, that's your head. Okay.
Yeah, and so I think at some point that will drive, because as long as the majors can deploy capital at NAV into assets, they're not going to be looking to do acquisitions at a premium. But I think it's at some point over the next few years that probably comes to a head. And when we look at kind of what the sector looks like, we see more consolidation. We think the bottom of this consolidation will probably happen like towards the end of this decade, like middle to 26, 27, kind of 28. We'll probably see the end of it where there'll be just a handful of companies that are going to be in this business. And how will we be positioned in there? And we see us kind of, we see the mid tiers kind of going up. Continuing to get bigger to be relevant. I mean, you have to be a $5 billion company today to even be remotely relevant to capital outside of this sector. There's no capital in this sector. So those companies are going to have to get bigger. Like they're going to have to make those decisions. And so I think there'll be a lot of opportunities in that, call it 50 million up to kind of $200 million range when we look out. And I think we're going to be a big beneficiary, and I think we're positioned very, very well to take advantage of it.
Interesting, because I always think like when these big mergers happen, the companies buy something, most of which they want, some of which they don't. They'll spin off non-core, they call it, just keep focused. How does it work with with sort of royalties and streams on tracts of land, which because those follow the asset, right? So we're going to need to see a lot more exploration in this space, surely, for royalty companies and streaming companies to actually be able to take advantage of the market going forward. Because it feels like everything's kind of, there's been a land grab. All the known stuff is like covered by the big boys, the weaknesses, etc. How do you guys identify new royalty opportunities versus picking up royalties that people perhaps don't want at a price that's right in a way that fits your profile? Because you've got a very certain type of profile,
right?
I'm struggling right now to kind of see where you go and find these things and the process. Like you got a new guy on board, maybe talk about him and his role with you in terms of how you can identify these opportunities. So to your point, we added Jason Cho this year.
incredibly experienced, diverse experience. Came from the operator side of the business.
Right.
Last 10 years at Eldorado, but also has a lot of experience on the banking and trading, and even the technical side. So, what we've done this year is kind of internally make sure that we were in a good position to be able to tactically go after these types of opportunities. Again, as you noted, much different than kind of what we've done in the past, and it requires some different skill sets. And so, Jason brings a wealth of knowledge on the operator side of the business to really give us a lot of insight to some of these bigger transactions and kind of how the big companies think about these things and so forth. But yeah, I mean, look, it's never easy. No. It's never easy, but I think that we're positioning our business to be able to go after these and execute on them.
Right, but tell me, I'm watching the conversation. So we're moving on to phase 2 of the company.
Yeah.
I've said, like, phase 1, you bought a bunch of stuff, sat back, waited. It's now that kind of step change moment,
right,
for growth, revenue coming in, and quantum leaps. It's all good. So that if people bought into that or want to buy into it now seems like a good entry point for you. And then the second part of this conversation is the eternal, so what next, Brad?
Yeah.
You know what I mean? Where we're going, right, how do we maintain this, maybe a dual track of growth, if it makes sense, where you've got revenue, which is in the bag, and how do we generate more to make your company more substantial and relevant? So what's the conversation look like for Mr. Cho when he's giving you this advice and he's opening a few doors for you? Like, what are you saying to these companies? What do you expect them to want now? What do you know that other people don't know to get deals across the line, new things in the portfolio?
Yeah, well, I would say that each transaction is still quite a bit different. We still have a big part of our business that I think we'll continue to have in the existing market as well. There are some much bigger opportunities that we've known about for a very long time, but just we weren't really in the position to execute on them as a smaller business. And so, we'll be looking at those types of opportunities. In regards to...
So, by execute, you mean we couldn't find cheap enough money to do the deals?
Right.
Okay.
Yeah, ourselves at least.
Yeah.
Yeah.
Okay. But now you are.
I think we will. Yeah, right. I think we will. I mean, look, it's still kind of early days into this next phase.
Yeah.
Of our business, and we're I think kind of by this time next year, I think we'll be in a very strong position from a balance sheet perspective, from an access cost to capital perspective. I think we'll see big changes from today.
Okay.
As the portfolio, is like Token Tanzino, we got paid on it first. Our first check was Q3, and La Guitarra. We've got Endeavor around the corner, which is guiding towards first production in Q2 of next year. On the back of that, we've got La Paria and Cote coming on, kind of our northern piece of Cote, and so forth, right? Like it's stacked up very nicely. And so as that profile of cash flow starts to kick up, like we will be able to get access to a traditional syndicated bank facility, and we'll be able to expand that facility. We think year over year, where we have a lot of other alternative financing kind of groups that have been in and around kind of us in regards to getting access to some of these opportunities. So like I think that I think we will be able to execute on it.
Good. Okay. And the institutions will need you to see you do that quarter after quarter for a period of time before I guess you can close in on some of that money.
Well, look, I mean, if you just look at 2024 as an example,
the revenue stack enough for them.
Well, look, they want to see it in the statements. But that being said, just in 2024, we kind of made a significant increase in our institutional ownership versus our retail. I think 2025 that will continue even further. And it's just a natural evolution process of the business. Like as they get bigger and they get more cash flows, they're going to attract a different type of investor. The opportunity here is that, given that anything that was even remotely in the future was so heavily discounted in the market, and this is not just with Metalla, it's basically across the board, that those discounts, even flowed through to the royalty companies, which is, we've never seen that before. I mean, at least in my career in the last 20 years, I mean, it was rare.
But you think it's fair, right?
Well, look, that's the market. Yeah. I'm not like trying to say the market's wrong. Like that's where the market's trading at, and we have to make decisions on kind of like, what do we do? Do we continue to execute a sound growth strategy?
Yeah.
Or do we change? And do we change for short term, a short term benefit for kind of at the expense of the long term, or vice versa? And so, we had to make those decisions, but I think that more institutions are going to see this opportunity, and then they're going to look at the valuation, they're going to look at the profile of these assets and say, like, look, like the profile of these assets, the risk profile of these assets, the growth profile. I mean, this is something that you would typically see in a mid-tier or a major, and where are they trading at? Where does the street have us at? I mean, we're one of the more undervalued. I mean, I liked it a lot more when we were the most overvalued. But we're on the other side. The pendulum swings in different directions, and I think kind of it has fully swung, unfortunately, in the other direction. We've continued to execute the business. We're kind of at this next phase, and I think we're on our way on the other side.
But it feels more realistic to me now than, say, back in 2020, 21 for you guys, which was a momentum play, and that's fine. People bought into the big idea, overbought on the big idea. But like I said to you last time, it feels a bit more grown up, a bit more realistic. And yeah, you're slightly being penalized for the behavior of others, of the actions of others, and the blow-ups from others at the moment, because it's risk off.
Right.
But it feels like 2025 is the moment it kind of comes through because of the quality of the deals that you did back in the day.
Yeah, and look, it'll set the business up to be in a very, very strong position. Over the next few years and into the end of the decade, and we see a path to, especially with kind of the more pressure of consolidation within the sector, we see a path to continue to grow this thing. I mean, it's great when all your competitors start to disappear every quarter. You've got one less competitor. And it kind of gets to a point where you're back at kind of where we were back in 2016, when there was only a few royalty companies that were out there. And it was a much, much different world. So we're excited. Look, we're excited. We have a bit of a cautious approach. We've got the luxury to continue to be disciplined with our growth and our strategy. We have a very good idea of how this business will transition, and we'll be able to continue to scale and grow kind of as a mid-tier, kind of doing those types of transaction and growing into, I think a leading mid-tier at some point down the road. It might not, it's not going to be tomorrow, but as you get into the end of this decade, like we will have a very, very strong profile. We'll be, in position to pay those dividends, I think, in the not too distant future here. And as one of the biggest shareholders of the business, like we're happy to do that, or maybe, buy back stock, or, we're going to be in a different part of our business, in the next few years. So.
What do I do with all my money? I love it.
Well, it's going into, it lines up well with the commodity markets.
Hey, compared to what's gone before, that's a fantastic position to be in. Like, I think it's super exciting for 2025. I think you've set yourself up well for people who are not in, maybe have a look around, because it's a very interesting time for royalty companies in your position.
Yeah.
Appreciate your time today, buddy.
Thank you.
Thanks, bye.
Yeah.